Reaching $100,000 from $10,000 by 2035 means you're targeting roughly 22 to 26% annual returns over 10 years. So everything in this list is pretty aggressive. It's growth-focused and comes with real risk. Let's walk through 7 individual stocks and 3 ETFs that combine strong historical performance with big 2026 to 2035 potential. Remember, past performance is no guarantee of future results. Note, all tickers and data points below reflect information available from November 2025. Sources like Yahoo Finance, Morningstar, Seeking Alpha, Bloomberg, ETF.com, and official fund websites. Imagine dropping $10,000 into a single stock or ETF today and seeing over $100,000 staring back at you by 2035. Sounds crazy, right? Yet some stocks and funds have already done this over the last decade. In this video, we're counting down 10 stocks and ETFs that could turn $10,000 into $100,000 plus over the next 10 years, if you can handle the ride. Welcome back. It's YieldZap Pro. And today we talk about building real wealth with long-term investing in plain English. Quick disclaimer, not financial advice. Always do your own research and talk to your financial advisor before investing. Top 10 Stocks ETFs. Important note for math, to estimate 2035 value. I am using a simple compound formula at the approximate 10-year annualized return each stock ETF has delivered so far. That does not mean it will necessarily repeat. Just want to point that out. Today's list is ranked by a blend of 10-year returns, current yield, size, fees, diversification, and analyst views. All right, let's dive into it. Starting with number 10. Number 10. Global X MSCI Argentina ETF, ARGT. Ticker plus name, ARGT. Global X MSCI Argentina ETF. Current price, November 2025. Roughly in the low 40s per share. Price fluctuates daily, pull fresh quote in edit. 10-year average annual return. Best performing international ETF over the last 10 years on Y charts with annualized returns above 20%. Dividend yield, around the 1 to 2% range, modest but positive. Market cap/AUM, multi-$100 million ETF, not tiny, but still niche. Expense ratio, around 0.59% per year, higher than a vanilla index fund. This fund owns a basket of big Argentine companies instead of just one stock. You're basically betting on Argentina's stock market and currency making a strong comeback over the next decade. If emerging markets start to outperform the US again, high-octane country funds, like ARGT, can drastically boost long-term returns. $10,000. 2035 projection. At a 20% annual rate, $10,000 could grow to over $61,000 in 10 years. If the next decade matches or beats its last, it could plausibly cross $100,000. Of course, that's a huge if. This is a concentrated bet on one volatile country, with currency swings, politics, and inflation that can crush returns just as quickly as they boost them. Number 9. VanEck Fallen Angel High Yield Bond ETF, ANGL. Ticker plus name, ANGL. VanEck Fallen Angel High Yield Bond ETF. Current price, November 2025. Trading in the mid-30s per share. Confirm exact quote in edit. 10-year average annual return, among the best performing bond ETFs over the last decade. A $10,000 investment 10 years ago would be worth well over $30,000 today, implying low teens annualized returns. Dividend yield, typically 4 to 6% yield paid as monthly or quarterly income. AUM, billions in assets, widely used by income-oriented investors. Expense ratio, around 0.35% per year. Check VanEck site for exact. This ETF buys fallen angel corporate bonds, companies that used to be investment grade, got downgraded, and now pay higher interest. You're getting bond-like income with a bit of stock-like upside when those companies recover. With interest rates still elevated and credit spreads attractive, fallen angels can offer a powerful mix of income and recovery-driven growth through 2035. $10,000, 2035 projection. At a 12% historical annual rate, $10,000 could grow to more than $31,000 in 10 years. If returns stay closer to the high end of its past range, it could get much closer to that $100,000 goal when combined with other growth holdings. If the economy slows sharply or we see a wave of corporate defaults, those high-yield bonds can drop fast in price, while some issuers stop paying. Number 8. NVIDIA, NVDA, ticker plus name NVDA, NVIDIA Corporation. Current price, November 2025. Trades in the hundreds of dollars per share. AI-fueled rally has made it one of the world's most valuable companies. 10-year average annual return, well north of 30% annualized over the past decade, turning $10,000 into well over $100,000 for long-term holders. Dividend yield, very small, typically under 0.1%. This is a pure growth story. Market cap, mega cap, in the top handful of companies, globally by market value. Analyst consensus, generally buy or strong buy, with analysts still projecting high earnings growth thanks to AI demand. NVIDIA designs the chips that power AI, data centers, and high-end gaming. When companies build AI models or huge server farms, they often rely on NVIDIA's hardware and software ecosystem. If AI continues to reshape every industry, NVIDIA is one of the purest, most profitable ways to ride that wave into the 2030s. $10,000, 2035 projection. If NVIDIA managed even 20% a year from here, far below its past decade, that would turn $10,000 into about $61,000 by 2035. If it somehow repeated 30% annualized, you'd be north of $137,000, but that's extremely optimistic. The stock is already priced for perfection. So, any slowdown in AI demand, new competition, or regulatory hit could cause brutal drops. Number 7. Meta Platforms, Meta, ticker plus name Meta, Meta Platforms, Inc. Current price, November 2025. Large cap tech trading in the hundreds per share after a multi-year rebound. 10-year average annual return. After a big drop in 2022 and strong recovery, long-term holders still show mid-teens to 20% annualized returns over 10 years. Dividend yield, historically zero, though buybacks are massive and a dividend remains a possibility longer term. Market cap, multi-hundred billion dollar mega cap. Analyst consensus, generally buy, with optimistic AI, Reels, and ad monetization projections. Meta owns Facebook, Instagram, WhatsApp, and more. Basically, they sell ads against a massive amount of your attention. They're also investing heavily in AI and virtual reality to drive the next wave of growth. As advertising shifts more into short-form video and AI-driven targeting, Meta has the scale and cash to keep growing profits through 2035. $10,000, 2035 projection. With a 15% annual rate, $10,000 would grow to about $40,000 at 20%. It could reach roughly $61,000, so you'd likely need Meta plus other high flyers to crack six figures. Regulation, privacy rules, or a big shift in social media habits could hurt ad revenue and push the stock into long slumps. Number 6. Invesco QQQ Trust QQQ, ticker plus name QQQ Invesco QQQ Trust. Current price, November 2025. Trading in the low 600s per unit after a strong multi-year tech rally. 10-year average annual return, around 20% annualized over the last decade according to Yahoo Finance performance history. Dividend yield, under 1%. This is about growth, not income. AUM, around $380+ billion in net assets, one of the largest ETFs on Earth. Expense ratio, about 0.20% per year. Analyst sentiment, underpinned by positive analyst ratings on its mega-cap tech constituents. QQQ is a tech-heavy ETF that owns about 100 of the biggest non-financial companies on the NASDAQ, names like major chip makers, software giants, and e-commerce leaders. Instead of picking one tech stock, you buy the whole tech basket. If AI, cloud, and software keep dominating the economy, a diversified tech fund like QQQ can capture that upside for the next decade. $10,000, 2035 projection. At its 20% historical rate, $10,000 would grow to about $61,000 in 10 years, a stretch scenario closer to 25% annualized, which would push you right around that $93,000 to $100,000 mark. Because it's concentrated in tech and growth, a prolonged tech bear market could cut your account in half, maybe more, before it recovers. Number 5, Global X Blockchain ETF, BKCH. Ticker plus name, BKCH. Global X Blockchain ETF. Current price, November 2025. Trades roughly in the teens to low 20s per share. Very volatile. 10-year average annual return. Among the best performing ETFs of 2025 with huge recent gains. Back-tested shorter history shows returns that can exceed 30% plus annualized in strong crypto cycles. But data over a full decade is limited. Dividend yield, minimal or near zero. Focus is pure capital appreciation. AUM, hundreds of millions, more niche than QQQ or SPY. Expense ratio, typically around 0.50 to 0.65%. This ETF invests in companies tied to blockchain and crypto, like miners, exchanges, and related tech firms. When crypto booms, many of these names can skyrocket, but they can also crash hard in bear markets. If crypto adoption keeps spreading and blockchain use cases mature, the underlying companies in BKCH could see explosive earnings growth. $10,000, 2035 projection. In a scenario where BKCH delivered 25% annualized over the next decade, $10,000 would grow to about $93,000 at 28%. It would roughly double that, crossing $100,000. But that kind of performance is far from guaranteed. This is tied to one of the most speculative spaces in finance. Regulation, crypto winters, and technology shifts can make the fund extremely volatile. Number 4, SPDRS and P500 ETF Trust, SPY. Ticker plus name, SPY, SPDR S&P 500 ETF Trust. Current price, November 2025, trades in the mid-500s, mirroring the S&P 500 index level. 10-year average annual return. U.S. large caps have delivered high single to low double-digit returns. Recent 10-year annualized returns have often been around 10 to 12%. Dividend yield, roughly 1.3 to 1.7%. AUM, over $400 billion, one of the biggest ETFs in the world. Expense ratio, low, around 0.09%. Analyst sentiment, represents the consensus U.S. large cap view, with performance driven by mega cap tech and strong corporate profits. SPY lets you buy the 500 biggest public companies in the U.S. in one trade. It's the classic own the market fund that many millionaires quietly build around. Even if it doesn't 10 times your money on its own, SPY is a rock-solid core that can anchor more aggressive bets on the road to $100,000. $10,000, 2035 projection. At 10% annualized, $10,000 becomes about $25,900 at 12%, about $31,000. Steady compounding growth that pairs well with higher risk names. If U.S. stocks enter a lost decade with lower valuations and slower earnings growth, returns could be far below the last 10 years. Number 3, a top-performing REIT ETF, example, VNQ-style REIT ETF. Ticker plus name, for example, VNQ, Vanguard Real Estate ETF. Current price, November 2025. Typically around $80 to $100 per share. Use live quote in edit. 10-year average annual return. Some REIT ETFs in Y-Chart's top 10 list delivered low teens total returns, including dividends, over the past decade. Dividend yield, often 3 to 4% or more, paid quarterly. AUM, tens of billions in leading REIT ETFs. Expense ratio, around 0.12% for broad low-cost options. REIT ETFs own a whole basket of real estate companies, like apartments, cell towers, warehouses, and malls. You get rental income in the form of dividends, plus potential price gains as real estate values rise over time. As interest rates stabilize or fall later this decade, high-quality REITs can bounce back and deliver a mix of income and growth into 2035. At 12% total return, $10,000 becomes about $31,000, stacked on top of other high-growth positions. That income and growth can help you reach six figures. Real estate is sensitive to interest rates and the economy. Higher for longer rates or weak property markets can drag down both prices and dividends. Number 2, a concentrated AI/innovation-focused ETF. Example, ARK Style Innovation Fund. Ticker plus name. For example, ARKK, ARK Innovation ETF. Current price, November 2025. Trades roughly in the $40 to $50 range after huge swings since 2020. 10-year average annual return? Because of massive gains early in the decade followed by big drawdowns, long-term, it has still delivered mid to high teens annualized returns over a full 10-year stretch in some Y-charts analyses. Dividend yield, essentially negligible. It's built for aggressive growth. AUM, several billions, though down from peak mania levels. Expense ratio, around 0.75%. This kind of ETF aims for moonshot innovation, AI, genomics, EVs, space, and other disruptive tech. Instead of researching each tiny growth stock, you let the fund manager pick a basket of them. If even a handful of its holdings become the next big winners of the 2030s, total returns could be enormous, enough to make a serious dent in that $100,000 goal. $10,000. 2035 projection. At 18% a year, $10,000 grows to about $52,000 in 10 years. At 24%, it's about $89,000. And a true 10-year rocket ride above 26% could push your stake into six-figure territory. These funds are extremely volatile, can underperform for years, and may never return to previous highs if the innovation thesis doesn't pan out. Number 1. Hand-picked high-growth stock basket. Example mix: NVIDIA, NVDA, Meta, plus 3 to 5 additional high-growth leaders. Here, rather than a single ticker, the number 1 idea is a focused basket of 5 to 8 elite growth stocks that each have a history of greater than 20% annualized returns and strong analyst support. Think of names like NVIDIA, Meta Platforms, and other top AI, cloud, or platform companies identified in November 2025 growth lists. A hand-picked growth basket is like building your own mini ETF of your highest conviction stocks. You might put $1,000 to $2,000 into each name, so one winner doesn't get drowned out by a loser. Historically, the biggest long-term winners, especially in tech, have often been individual stocks, not funds, and a well-chosen basket may be your best shot at a true 10 times by 2035. $10,000 to 2035 projection. If your 5 to 8 stock basket somehow averages 22% annually, $10,000 turns into about $73,000. In 10 years at 26%, it would cross $100,000, similar to what past decade mega winners have delivered. Stock picking amplifies both upside and downside. Choosing the wrong names or overpaying can leave you with far less than an index fund. Quick bonus section, because most of these names are not cheap per share. The good news? With fractional shares, you don't need $600 to buy one share of QQQ. You can start with $5 or $50 and own a slice. Apps like Fidelity, Schwab, SoFi, and Robinhood all offer fractional trading on many stocks and ETFs, letting beginners build positions gradually instead of waiting to save up for one full share. Take a simple example. If you invest $500 a month into a growth-focused portfolio, returning 12% per year, in 10 years, you'd have roughly $116,000. That's not just deposits. It's growth on growth, which is the magic of compounding. Here are some common mistakes newbies tend to do which you will want to avoid. going all in on one hot stock and then panic selling at the first big drop. Ignoring diversification. No single name should usually be more than 10 to 20% of a beginner's portfolio. Forgetting about fees, high expense ratios, and trading too often can quietly eat your returns. Investing money you actually need in the next 3 to 5 years. Chasing past performance and assuming the next 10 years must look like the last 10. If you're still here, you're serious about turning $10,000 into something much bigger by 2035. Just remember, none of this is guaranteed, and every stock or ETF on this list can drop 30%, 40%, even 60% along the way. Question for you: which one of these ideas would you research first? NVIDIA, a broad fund like QQQ, or a wild card like BKCH? Drop your answer in the comments and tell everyone why. If this breakdown helped you, tap that like button, subscribe for more long-term investing videos, and share this with a friend who keeps saying, "I'll start investing next year." Remember, your 2035 self is watching what you do in 2026.